keep you updated on the capital and financial markets. Here is a recap of what happened. Thailand's mutual fund industry assets shrank nearly 14% in the first 9 months of the year as global central banks hiked interest rates to rein in soaring inflation, prompting investors to pull out of bond funds, according to figures from Morningstar. Total net asset value of Thai mutual funds as of end September was 3.7 trillion baht, down from 4.3 trillion baht at the end of 2021, Morningstar says in a report. Bond funds suffered the largest net outflow of 240 billion baht over the period, though fixed-term bond funds drew a small net inflow of 20.4 billion baht. There were smaller outflows from other funds, including large-cap equities and European equities. Overall net outflows were 230 billion baht. The UK's financial regulator made clear it will no longer tolerate vague ESG fund designations, as it moves to crack down on investment managers that can't back up their claims of targeting environmental, social and governance metrics. Fund managers operating in the UK will face a package of new measures, including investment product sustainability labels and restrictions on how terms like ESG, green, or sustainable can be used, the Financial Conduct Authority said in a statement on the 25th of October. The Monetary Authority of Singapore on the 26th of October published 2 consultation papers proposing regulatory measures to reduce the risk of consumer harm from cryptocurrency trading and to support the development of stablecoins as a credible medium of exchange in the digital asset ecosystem. These measures will be part of the Payment Services Act. Trading in cryptocurrencies is highly risky and not suitable for the general public. However, cryptocurrencies play a supporting role in the broader digital asset ecosystem, and it would not be feasible to ban them. Therefore, to reduce the risk to consumers from speculative trading in cryptocurrencies, MAS will require that DPT service providers ensure proper business conduct and adequate risk disclosure. Federal regulators on Wednesday adopted rule changes intended to make it easier for consumers to understand what they're invested in and how much it's costing them. Under amendments approved by the U.S. Securities and Exchange Commission, investment company ads will need to promote transparent and balanced presentations of fees and expenses. Additionally, shareholder reports from mutual funds and exchange-traded funds will need to be concise and visually engaging, according to the SEC. The U.S. Securities and Exchange Commission on the 26th of October proposed a new rule and rule amendments under the Investment Advisors Act of 1940 to prohibit registered investment advisors from outsourcing certain services and functions without conducting due diligence and monitoring of the service providers. Registered investment advisors, more than 15,000 of them in total, play a critical role in our economy, advising more than 60 million accounts with combined assets under management of over $100 trillion, said SEC Chair Gary Gensler. Though investment advisors have used third-party service providers for decades, their increasing use has led staff to make several recommendations to ensure advisors that use them continue to meet their obligations to the investing public. When an investment advisor outsources work to third parties, it may lower the advisor's costs, but it does not change an advisor's core obligations to its clients. Thus, today's proposal specifies requirements for investment advisors designed to ensure that advisors' outsourcing is consistent with their obligations to clients. This has been the FIMM TV Weekly Recap. Be informed, stay updated. Be sure to like, share and subscribe.